Well, if the markets survive Putin, they still have to meet Powell, and that's going to be the tough one. So the conflict in Ukraine has accelerated the trends that were in place before the war, meaning deglobalization, shortages of oil, and now we're facing higher prices in agriculture, commodities, and oil. That's just putting more pressure on the Fed because the Fed is already behind the curve. So now if you look at the Fed and what they can do, well, if we go back to 2018, the balance sheet was about $4.5 trillion or 23% of GDP. Today, it's roughly just a little under $9 trillion and 37% of GDP. Back in 2018, Q4, the market dropped 20% when the Fed just did QT light by cutting just $400 billion. So if we look at the risks today, we still have the uncertainty of the conflict in Ukraine. I think the market's way underpricing that. And then you walk into a Fed that's got to get more aggressive. Mm-hmm. So the combined impact of those two are certainly going to have an impact on the market. That's why we are very cautious here.
I understand. I mean, and Weiss, to your point about FedEx and the transports, you know, John Spallanzani points out, it's like, hello, I mean, you know, the inversion. Those kinds of stocks, more cyclical natured stocks, don't like an inversion of the yield curve because, again, it puts recession on the clock. At least that's what the narrative is. So stocks like FedEx and some of these others. And when I look at these names, JB Hunt, so many of them today are down. Union Pacific, CSX, so the rails, the freights, these other names are all down across the board today.
Yeah, that's true. But look, I think it's old school thinking. You've got still phenomenal tailwinds in terms of online. These companies are at full capacity and then some. Cyclicality, well, then why isn't copper down? Commodities are as cyclical as you can get. And I can give you other stocks, not just commodities, that aren't down what these stocks are down. And look, by the way, where FedEx is relative to where it's been for the year. So I don't think that's it. I mean, if that were the case, you'd see just a much broader decline in the market today. So there's something else going on there. I just don't know what it is.
I mean, it's a pretty precipitous decline. There's the transports down 4.4%. Who's going to say something? Was that you, Rich?
Yeah. So look, we had a situation where we had supply chain shortages, and that's because the consumer bulked up during COVID. Now the trends are going to move from purchases to experiences, from buying more gas grills and backdoor heaters to restaurants, travel, leisure. So I believe there's going to be less pressure on the supply chain and less pressure on inflation as a result of that. And you'll have reduced demand, even though they're operating at full capacity in the transport sector. Plus, you have the situation where Amazon is building out their own logistics.